Hello everyone, welcome to Blue Dragon Actual. So today we are going to start the series of 5 minutes video because most of us are having exam and they would not have the time to kind of go through such long length videos. Yesterday I had an analysis of surplus session of which there was a problem that was left, and I thought that I'll cover that problem today. Maybe it will take slightly more than 5 minutes, but that's okay. It's an important problem. So let's first understand the question first. A life insurance company has the ability to pay 100 in 2 years time, right? Has a liability, not the ability, liability to pay 100. So it will be 100 and 100, and there are no more premiums available. So premium would be zero. So if you consider from this, if you apply the definition of reserve just from this information, it will be 100 and 100, which will be liability, which will be discounted back because that is a present value of benefit, right? And premium would be zero. So expected present value of benefit will be 100 and 100 divided in discounted. So if you remember the Excel example that I had, so something like this, right? 50, 20, and you are discounting it back, right? So that's, but in this case, there is no premium. And also in the question, there is no premium. Sorry, let's move on. Okay. So discount rate that is to be used is 0.5%. Now this discount rate is the expected discount rate, right? This is not the actual discount rate. This is the expected. We are expecting this to be the interest rate. Expense in 6 months, once again, is 5, and expense in 18 months, once again, is 10, right? So expected present value of expense would also be can also be calculated based on this. It will be 5, and then unlike this, which is 100 in 2 years time, which is kind of divisible by which is kind of discounted by 1.05 plus 1 plus 0.05 to the power 2. This would be kind of discounted accordingly by 6 months and 18 months, right? And the company has asset over 200 rupees. Calculate the surplus at the start of the year. So if we need to calculate let's just go through the entire problem first, and then we'll see the entire solution. So during the year, the company actually achieves a uniform investment of 4.5%, whereas this is the actual return. So this was the expected return, this is the actual return, and incurs an expense of 15 in the middle of the year, right? So instead of 5, the company incurs an expense of 15, right? So what this is, so this 5, we know that because liability is calculated on the valuation basis is expected, right? I have already covered that in my yesterday's analysis of surplus video. If you have not watched that video, you should watch this video after watching that video, right? Now, so you know that anything in the valuation basis is the expected one, right? But anything in the anything which is kind of actual incurred is the actual one, and impact would have that impact would be felt in the asset side, not on the liability side, because liability would move as per the expectation, right? But the asset side would move as per the actual rate, and that's where the surplus would change, right? So at the end of the year, valuation is performed during the same basis as above, and discount rate is 0.5%. So after this year has ended, so what they have, although the investment return was 4.5%, instead of taking discount rate of 4.5%, it was still kept as 0.5%. One of the reason would be that the company felt this is a one-off case, right? And expense in 6 months, like after that, like this 18 months expense was also expected to be 10, right? Because 1 year has already passed. So 6 months, after 1 year would be 18 months. So calculate the surplus at the end of the year, hence deriving the surplus. So first we need to calculate the surplus at the start of the year, which is kind of very which is easy. The company has asset of 200, and then you get this figure. You can calculate this liability, right? And in this case, they are kind of they are kind of thinking that the company is starting from that time period, right? Otherwise, it would be change in asset and change in liability. That concept you have seen in the in my original analysis of surplus video. So, anyways, so here they are considering that as asset and liability only. So asset and liability they are considering that is equal to surplus, which is an incorrect thing to say, but we are assuming that in this case. So let's just assume that so that we can follow the flow of this problem. So analyze surplus into following categories: expected return on opening surplus, which will be expected return means return multiplied by the discount rate, right, which is this 0.5%. Investment return, and this also represents unwind, right? This also represents unwind. And investment return variance, so 0.5% and 4.5%. What is the variance, right? So and then is the expense variance. So expense variance is because there is a 5, and in the same time we have 15, right? And that we need to calculate. So how we calculate this? We'll calculate the asset movement, and we calculate the liability movement. Asset would be impacted by the actual thing, right? Liability would not be impacted by the actual thing, but liability will move as per the expectation. And the difference between these two would give us the surplus. So first question is calculate the surplus at the start of the year. So what I will do is I'll take the 100 and discount it 2 years. I'll take this expense 5, discount it by 0.5, right? And this take this and discount it by 1.5. Like that is the power to 0.5 and 1.5 will be power, and that will give me the liability, right? And I already have the asset which is at that point of time, which is given, which is 200. So 200 minus that will give me the surplus. So let's see what the they have done the exactly same thing. 100 v square, 5 v and half, 10 v 1 and half, right? 113.2, which is the surplus, that is 86.08. Next question, expected return on the opening surplus. Expected return, that means the unwind, right? Expected return would be given by multiplying this 0.05 with the surplus that we have just calculated. So this is 86.05, right? 86.86 is expected return on the so they have also calculated the surplus at the end of the year, right? Okay, so I missed this portion, surplus at the end of the year. Let's just first finish this portion and then we'll come back to the second portion. So expected return at the on the opening surplus 86.08, right? And because it is expected return, so we'll use the valuation discount rate, because that is the expected thing, right? So 0.05% into 86, which gives you 0.43. Now let's come back to the surplus at the end of the year. When we are calculating surplus at the end of the year, we again have to calculate the liability, and that would be based on the prospective valuation like earlier. So what would be the liability in this case? That 100 that is expected to pay after end of 2 years, that is still required to be paid after the end of 1 year, but right now it would be 1 year, and the same discount rate would apply. This would be and same discount rate would apply because it is 0.5%, and expense would be 10, because it has not changed, right? Expense in 18 months, expense 6 months, it has not changed. So if you see here, what would be our liability? So surplus at the, let me read the question. Calculate the surplus at the end of the year and hence derive the surplus. So, oh, sorry. So the surplus at the end of the year, not the liability at the end of the year. It represents the surplus at the end of that. So in order to calculate the surplus at the end of the year, what I need to do is to first calculate the liability, which is as per the process that I've explained. So obviously we'll have the 100 which is due in 1 year. We have this expense 10 which is due in in 6 months, right? So we'll calculate the liability. Now in order to calculate the asset, right, because asset will vary as per the actual return, right? So asset was 200, right? Asset initially was 200, and that would vary as per 4.5%, right? That instead of moving at 0.5%, asset would move by 4.5%. However, there is also an expense that was kind of incurred, which is this 15 rupees expense. Yeah, this is the 15 rupees expense. So asset would so 200 200 minus 15 would be kind of so 200 would grow at 4.5% per annum, and 15 would grow at 4.5% for half of the year, and the difference between that will give you the final value of that. So let's see what they have done. So yeah, 200 into 1.045 and 15 into 1.05. Because this figure is also increasing, right? This figure, this is, although this is a negative figure, this is also increasing. This is also gaining the asset, and that's why it is 193.3. And how we are calculating liability, that 100 is due and the 10 expense is 10, so 109.48. So this gives us the asset at the end of the year, and this gives us the liability at the end of the year. The surplus is given by 193.67 and 109.48, which is 84.19. So the movement from 86.08 to 84.19 is the surplus that is arising. So 84.19, which is the end of the year surplus, minus 86.08, which is minus 1.89. We have already covered this expected return on opening surplus. Investment return variance. So in this case, what we'll do is we'll calculate it in a similar manner. We'll only change the investment return, right? We'll only change the investment return assumption and see how the variance is happening. So first we'll calculate the movement of the asset with the expected return, which is 0.5%, and then we'll calculate the movement of the asset with the actual return. The difference between these two would give us the investment return. Now it will not impact the liability. Why? because liability would only be impacted by the expected discount rate. Had the expected discount rate been changed, then liability would have impacted. But actual would not impact. So liability would be the same, right? So actually, what I would have to do is I have to calculate the asset using 4.5% investment return. With the, I mean, obviously this expense also need to get subtracted, and minus liability would give us the value of surplus. And similarly, I have to calculate the asset with 0.05%, and then subtracting this expense for the half year period, and then subtract the liability. But liability in both these cases would be the same, and the difference would be given by these two surpluses. So liability will cancel out, right? And that's why we have not because liability is not going to impact this calculation. We can only simply calculate the asset and take the difference, and that will give us the figure. So let's see, actual value of the asset on actual investment returns. We have just calculated that, which is this 193.67, and using 0.05 is 200, which is 185.96. So 193.67, actually it should be minus liability, right? That would be placed in a bracket. 193.67 minus liability placed in a bracket. 185.67 minus liability placed in a bracket. That would give you the investment surplus, which is 7.71. But we don't need to do that because liability will not change. Liability in this case would be 109.48, right? So actually it should be 193.67 minus 109.48, and this would be 185.96 minus 109.48, which will give us the 7.71. So investment return variance is only given by the change in the asset value, and that's because that is the change in the actual investment return, and actual investment return only impact the asset. So finally, next was the expense variance, right? So expense variance, once again, what has happened? Expense variance has, there is expense variance because of 15, right? The expense of 15, which was incurred in the middle year, and it was supposed to be 5. So what we are going to do, once again, we are going to calculate, obviously this is an actual thing, right? What it would impact? It would impact the asset side. It would not impact the liability side. So because of that, we'll start with the asset and we'll calculate, and in this case, we'll keep the value of the investment return same, right? We'll keep it as say 5%, right? Because otherwise we don't want impact of the investment as well as the expense there. We only need the impact of the expense variance. So in this case, we'll consider, say, the discount, the asset is growing as 5%, or you can also consider the asset is growing as 4.5%. It doesn't matter. It has to be kept constant. Now, asset is, you are considering the asset is growing as the, say, 0.45%, and then once you will subtract 5, and once you will subtract 15, and the difference will give you the result. And once again, it will not impact liability. Why? Because it is the actual figure, right? Actual figure is always supposed to impact your asset and not the liability, right? Because liability is forward looking, and the actual figure, so when you are standing on, say, 31st December 2022 or 2021, your liability is given by the cash flows which are occurring after 1st Jan 2022, right? Assuming you are standing on 31st December 2021, your liability will be given by the cash flows which are on 1st Jan 2022 and onwards, because that's a prospective valuation. However, your asset was sitting at 1st Jan 2021, and it has to be rolled forward to 31st December 2022. So that's why the asset side would be impacted by the actual numbers. Liability will not be impacted by the actual numbers. It will always be expected numbers, because you don't know what will happen in the future, right? So you have to use some assumption. So that's why I think the concept is ample clear now. Now, if you see here, they have used the 1.05%. So 200 into 1.05 minus 5. And obviously, based on the actual experience, they have already calculated it here, right? 185.96. So 185.96, 200, that gives you difference between that is 185.96 minus 195.99. Once again, there would be a minus liability. Actually speaking, there should be 185.96 minus liability, minus of within bracket 195.99 minus liability, which will give you minus 10.03, right? There is another way you can calculate the expected variance, which is this way, right? Actual expense variance is, actual expense is 15, expected expense is 5. So 15 minus 5, which is 10. And if you multiply this with the expected valuation rate for the half year period, you will get the result. So what it means is you are getting a variance of 10.03 for expense. You are getting a variance of 7.71 positive for investment, and you are also getting an unwind of 0.03, right? And this three should sum up to the this figure of minus 1.89, because remember that question where we mentioned that the individual variance should be equal to the total variance. In ideal scenario, actually there would be some unexplained, but in this case, because it's such a simplified example, that would be the case. And here you can see that surplus arising 0.43 plus 7.71 minus 10.03 is equal to 1.89. And the surplus we have also calculated is 1.89, right? Or the deficit we have calculated is 1.89. So this is matching. So that means you are able to kind of allocate your movement in surplus in this three bucket, and that accounts for the variance, right? And this is important because sometimes the unwind might be high, sometimes the investment surplus might be high. So in that case, you will understand that as compared to the previous year, there is no error or there is no calculation mistake, there is no change in assumption, or we need to probably change the assumption because every year the investment surplus is very high. So we probably can pass on some benefit to the policyholder and have our product be more competitive, right? So I think, I hope this is clear. Other than that, there was a very small section left, but that was not very relevant for us, which is analyzing the movement in risk margin. So I mean, analyzing the movement in capital, this depends on the definition of liability. And so your surplus can be given by asset minus best estimate liability, or surplus can be given by asset minus best estimate liability plus risk margin, or asset minus best estimate liability plus risk margin plus capital. So definition of the surplus changes, right? And you have to kind of do the similar calculation for bucketing them in different categories. However, your liability definition can change, and that is kind of written here. You can see a technical provision equal to best estimate plus liability. So you can also have liabilities definition as only best estimate. You can add the risk margin. So that's the simple concept. So I hope this problem is clear. So as I mentioned at the start of my the previous video when of analysis of surplus, that if you understand analysis of surplus, just the theoretical understanding, it is very important. And also you need to understand the transaction. I gave an example of revival policy, right? Revived policy. So that would cause source of surplus. When I was working on this, analysis of surplus, so most of the time the major difference come from that revived policies, which is very difficult to track, because unless you know that there can be some difference like that, you have to kind of go each month and each quarter and see what is not present in the new business file as well as prior period file, what is that is present in the current file. And especially in Indian companies, there is a limitation of computation ability, right? Because there are, I mean, crores of policies or lakhs of policies that are written, and sometimes it is very difficult to do those calculation in Excel. In outside foreign companies, you have SQL where you can just do a select this and accept this. You can very easily get the revived policies. But Indian companies, sometimes it is very difficult. Anyways, that is my personal experience. However, getting the difference or the divergence in the case of assumptions, or the divergence in case of actual assumptions, that is not that difficult to get. And one more thing about the analysis of surplus is you have to do the analysis of surplus in the same order. So for example, if you usually in the previous year, you have done it from opening period, then modeling adjustment, then modeling adjustment to new business, the new business to expected assumption impact, then actual assumption impact, and then financial assumption impact, right? So if you have moved in that manner, you should always move in that manner. Otherwise, it will be very difficult to kind of match. The sequence should remain the same. Otherwise, it will show, although eventually some of everything would boil down to the total difference, but if you don't follow that, it is very difficult to have an year-on-year comparison. So the sequence in the analysis of surplus, how you bucket every year, that should remain the same. So anyways, I think it got slightly more than 5 minutes, but from next Wednesday, we'll kind of revise the concept that we've learned today. And as I mentioned, participating policy will be covered in August. So please, if you enjoy this content and if you are learning something, if your actual career is, is helped by this, then please like, share, subscribe, hit the bell icon. And if you have any feedback regarding anything, regarding the method of delivery, or regarding if you are somehow something somehow offend you, which I've said, please leave a feedback in the comment section. Yeah, and then don't troll. There is no point in trolling anyone, right? So please leave a feedback, and I'll work on that. Thanks for watching, and see you in future videos.